Let's talk occupancy. Hi guys, my name is Charlie Shammy. I'm the CEO of a company called Sonic Loans, multi-state lender located in Michigan. And today I want to talk to you about occupancy. We get a lot of questions about this. A lot of questions about what the occupancy should be and the different down payment amounts for different occupancy types. And what I believe is this should never be a question. There's three types of occupancies when you're talking about mortgage. One type is primary residence. This is if you are going to move into the home, you're going to sleep in that home, your driver's license is going to show the address to that home. You look up your cell phone bill, your DTE, look at any bills, the address there is this property. You're going to live in the house. There shouldn't be any gray area there. Are you going to live in the house? Are you not going to live in the house? If you are, it's going to be considered a primary residence. There's another type where it's called a secondary residence. Some call it a vacation home. Some think this is just if you get a second house. But a secondary residence / vacation home is a home that has vacation amenities. Let's say you live here in Michigan and you're buying a home on the West Coast right on the lake, or Florida, or somewhere where it has like a beach or next to a park or something, some kind of vacation amenity. It could be near family. It doesn't have to necessarily have the vacation amenities, but that's what they really look for. And the caveat with a secondary home or a vacation home is nobody else can use that residence as their primary residence. Nobody can live there except you, and you use it. Now you can rent it out for part of the year, but nobody can have it as a permanent residence. It's going to use it that way, or it's going to be classified as the third type, which is investment property. This is where you get the most questions. When somebody's trying to, this house down the street from mine, I want to buy it, or I want to buy a house for my sister to move into it, her and her husband. Any scenarios like that where you're not going to live in the house and somebody else is going to have that home as their primary residence, somebody else is going to live there, that's considered an investment property. We get questions of, hey Charlie, I'm not going to collect rent on the home. It's still an investment property. If your parents are going to move into the house, here's a nice caveat that a lot of people don't know. If it's either elderly parents where we can prove they don't make enough income, so we can actually do that as a primary residence, even though you're not going to live there. In your name, parents are going to live there. We prove they don't make enough income to qualify for the mortgage, then it can be a primary residence. A child, so a parent buying a house for a child. If we can prove the child is, God forbid, but if the child is handicapped in any way and can't make that payment, even though the parent is not going to live there, the parent can buy the house, get the mortgage in their name, and still be a primary residence. So there's a couple caveats there. But most of the time, if somebody else is going to live in the house, that's the rule of thumb, it's going to be an investment property. And why is this so important? Many reasons. One, I think the first one that people look at is the down payment amount. The down payment amounts are different. For primary residence, you can put as little as 3% down. For secondary home, it's 10% down. That's the minimum. For investment property, the minimum is 15% down. A little tough to qualify for 15% down, so they really want 20 or even 25% down, depending on how many units it is. So it's important first and foremost for the down payment. Second, for the pricing. Primary residence pricing is much better. It's also important because you have to understand what's on the other side, not just from your perspective, but what's on the other side, the people actually paying the money, lending the money out, the investors on the back end that are lending it out, and why they have these different changes. Most of those investors are government backed. So why does the government or the investors care if you're going to live in the house or not? It all comes down to risk. The higher the risk, the higher the down payment and the higher the interest rate. The lower the risk, the more they're comfortable accepting a lower down payment from you and giving you a lower interest rate. It all comes down to risk. Now you can say, hey, what if I just say I'm going to move into the house and then I buy it and rent it out? Well, you can do that, and maybe somebody finds out, maybe somebody doesn't, but I would highly advise against it, especially keeping that from your loan officer, because what you're doing is committing a felony. It's mortgage fraud, punishable by up to 20 years in prison, and I believe the number is $2 million. It's not worth it. Why do that? Just follow the rules, follow the guidelines. Understand the differences between them. However your loan officer is structuring occupancy is really important. Make sure you go over everything in detail. Let them know exactly what your intentions are for this home that you're buying so they can structure it correct, because even if they make a mistake and structure it wrong, you're both on the hook for that. So make sure it's all done the correct way for you and your family's sake. That's occupancy. It's really important. A lot of people don't understand it, especially when they're not going to move into the house. They don't understand why the differences are there, but I hope this gives you a better idea of why the differences are there, the perspective of the investors. Make sure you're letting your loan officer know exactly what your intentions are, exactly what you're going to do with the house, so they can have that structured the correct way. Thank you guys. See you on the next video.